eminent expert, Ajay Srivastava, Managing Director at Dimensions Corporate Finance Services, joins us right now on the show. Ajay, good having you. Thanks so much for joining in. You must be thinking that we get you on all days in and around the elections, but that's not the case. We love you having in even otherwise. But having said that, it's important.
So nice of you. Thank you so much.
No, Ajay, but it's important the next couple of days, isn't it? I mean, fractured mandate as of now, assuming that that's how it turns out to be the case, what do the markets take away from it?
You know, we believe that at this point of time, there are bigger issues than just a fractured market in political mandate. Because even if you look at this election, it wasn't fought on any economic platform or policy platform. It was same old caste issues which were on the forefront and all the miscellaneous issues. You can't run away from the fact that you are staring at a very large fiscal deficit. The yields are very high. Market results have been very, very kind of mediocre given the base effect has not played out. And you are still sitting with the large caps leading the market. So therefore, nothing much materially changes whether the verdict is in favor of one party, two parties, fractured, coalition. I don't think that's material. Material is indifferent results and a macro which is slipping away slowly and slowly.
So, Ajay, you know, these concerns over the macro now have been there for a while. In fact, the yields have only gotten stronger, the currency's only gotten weaker. The situation doesn't look all that great. I mean, the small data release, though I kind of really discount IIP usually nowadays, but even that wasn't the greatest. Despite all of this, the market seems to have climbed the wall of worries, 10,800 odd, not deterred even in the run-up to the election verdict. Seems to suggest that the market is not too bothered about what the election verdict could be, or the market has already priced that in. What's next now? I mean, the earnings season also has not been, you know, gangbusters really.
See, you know, if you look at the market, what's holding up the market? I think it's a very skewed market again. It's basically driven by the old vanguards. It's driven by the large caps. I don't think so you have any kind of a serious recovery in most of the mid-cap stocks which are bleeding. And I think the flight to quality will continue. I think that's the bottom line in the next 6 to 9 months is that you not need to migrate yourself to the larger players. You need to migrate yourself to the bigger players in the market with the larger market caps, and you will not find ready buyers of the mid-cap stock. You know, apart from the adjustment for the mutual fund, which is going on in process thanks to the new regulations, you are having a troubled time getting out of your mid caps, and they have not recovered. So if you look at the index, what held up the index? Index was held up by HDFC Bank, Kotak Bank, HDFC, Hindustan Unilever. The oil companies got slaughtered, and assorted, and L&T holding firm little bit here or there. Maruti got into a correction. Eicher held firm. So you know, if you look at the market, it's very, very skewed. If you in the advanced decline ratios tells you what's happening to the market and where the prices of mid-cap are. They are not recovered. So, you know, market is very smart. I think anticipating this kind of turbulence, macros, it quickly moved itself towards the large cap, and that's what held the market firm. And I think the next big wave will happen now in the next month or two, as people start to figure it out that, you know, in the next 12 months or so, with uncertainty going up, mid-caps are not going to revive itself into a major frenzy. So you might as well trail the old foggies at the end of the day. So yes, it's good to say market held up, but what held firm depending on what you held in the portfolio. People who had mid-caps, I don't think will agree with you. People who had large cap will say, yes, it's a great gangbuster market.
Well, Ajay, good morning to you, and at least that's the case that we've been seeing on screen. The broader markets, they have been underperforming the benchmark indices. I'm just going to deviate back towards the election result. Just want to check, if BJP comes into power, do you think their victory is priced in at current levels of 10,800? And second part question, if not, if the verdict goes against them, how much downside do you see for the markets?
I don't think very much. Personally, I don't think very much there will be a downside to this market, because what's the next stage? It's going to be either a Congress victory or a coalition. Let's assume it's a coalition. Nothing much going to happen to the economic policy, the national policy of this country, except the fact that now you will have bigger questions on whether Rajasthan will be won, or Madhya Pradesh or Chhattisgarh or the national elections. But I think the underlying thesis that we are working upon is that political mandates do not make a difference to stock market. Now that's a big assumption we are making. It may take a short-term gyrations, which we have seen in the past when parties lost and parties won, but the short-term gyrations got bought into or sold into depending on which way you were positioned. And let's take the worst case scenario. You have a fractured mandate 2019, or if you look back and say we are a decisive mandate, but decisive mandates can also have missteps like demonetization. We had 2 years of mediocre performance for various reasons when the oil prices were low. So I think there's no certainty to the fact that a clear mandate gives a great economic boost versus a fractured mandate or a coalition which will all be negative. Yes, emotional reactions do come and go, but I think market has to fundamentally deal with the fact that how does India deal with oil prices, NPA issues, high interest rate which are staring at us, and more critically, the fiscal imbalance coming, because if the only implication I see of the fractured mandate is the kind of push towards a little bit more fiscal irresponsible actions like loan waiver, which have already been announced in Karnataka by the ruling party, and if more of such steps start to unroll in the next 6 to 9 months, then the yields are going to be out of control, and then you will have an economic situation to manage. All it tells us is that the people who can weather the storm, whichever way it works, ruling party, not ruling party, fractured mandate, is the large caps who don't have too much of leverage on the books. They have unmistakable winners in the next 12 months, because in a worst case scenario, a lot of people will fall off the cliff. They will have more NPAs because if interest rate goes up, and foreign exchange loans now will get repriced with a new 4-5% increase in the liabilities. Now all those going to start hitting the balance sheet in June as well. So therefore, the thesis of the market remains irrelevant, irrespective of what the mandate is. Flight to safety, flight to quality, leverage is no way in the preferred list now.
Wow. Are you betting on some of these beaten and slaughtered names? I mean, the price changes have come about in the OMCs and they've shown that uptick the last couple of days. Pharma the last couple of days, or the last few days, if not weeks, has been in the thick of action as well. Activity, if not substantial price changes. Are you still continuing to bet on the large cap preferred names, as you mentioned, the old fogies, or are you even betting on the large cap names, but which have kind of been beaten down, Ajay?
See, large cap portfolio continues. I think what new has come in the last month and a half is pharma space. I think we started reinvesting back after almost 3 years back into the pharma space on the back of rupee dollar devaluation. And we will start now investing into the MNC stocks as well. MNC we were avoiding so far, but I think given the Trump's policy on drugs which is coming through, and that president acts so fast, you should see a lot of traction coming in the MNC pharma companies, because if he goes after the price controls in India on the drugs, these companies can reap a bonanza, absolute bonanza. So it's a long call. It's not going to happen immediately, but the long call is that the MNC pharma companies could be the best place to be in the next year, because they should see a bonanza thanks to the political policy there. So yes, pharma, yes. Now, and OMC is a mixed bag. OMC is a very mixed bag, because on one side, the great value picks, it's the lowest ever. How do you get a stock which is such a franchise at less than 2 times book value? So yes, there is a temptation to do it, but then you hold your hand back and say, listen, can you spend your money better elsewhere? Because what happens in the next 12 months, government policies, oil price increase, their balance sheets, one doesn't know where it's going to come from. So yeah, there could be a good value picks, but whether you are buying with conviction, I am not sure. So we have not positioned ourselves in OMC. They've seen a small uptick. I saw IOC going up from 160 to 170 odd, but the odds are pretty well stacked against them at this point of time in the election year.
Ajay, what's the view on the consumption pack? Obviously, the valuations appear to be on the higher side, but majority of the earnings so far have been strong.
All good things are expensive, and so are these stocks. The best stars get paid the most, the best cricketer gets paid the most, the best news anchors like you guys get paid the most. So obviously the best stocks get paid the most. So I think you should not worry too much about these stocks in terms of pricing. Find every opportunity to get in, because these are franchise stocks facing a phenomenal future. So I don't think you should lower down on your consumption basket. I think you should keep adding up. If you look at the whole credit profile, where is the credit profile going in this country? Is all retail credit. Where is this aspirational class trying to buy into? Is consumer product and services. So why not bet on that? Why do you want to bet on esoteric subjects like infrastructure, etc., where there's so many imponderables? Or why do you want to bet on nationalized banks? Why do you bet on all these things? Just focus your bets, keep private banks, consumption stories, and pharma maybe a little bit here or there, and a few value picks. I think, this is a year to be safe and sound and not be so sorry, in our view. That's the way we should play this portfolio out, and therefore one would tend to believe that consumption is the safest place to be. Zero debt companies, most of them, good growth, sound management, transparent practices, retail franchise, they never go down. Look at Dabur as a stock, look at Britannia as a stock. Have you ever seen a correction in them in the last 5 years? And you don't want to see a more correction in these people for the next 5 years as well. So stay put. This is a great story for India. You cannot go wrong. And if you are an investor in the market, you cannot not have them in the basket, because otherwise you are betting on the wrong things. You will never have a consumption going down and infrastructure going up in a country like ours.
Okay, so remain bullish on the consumption pack, which has been outperforming as well. Ajay, appreciate you joining us today and taking us through your views on the markets and also on the Karnataka election results, which are due for tomorrow. Well,